Can I say badass on the radio?
Whoops.
Yeah. Why would you want to say badass?
Sorry, guys. Here we go. Welcome to Silicon Valley Impact, where business insight meets startup innovation. And now, your host, Brian Sparks!
I love it. Brian, that's always my 15 seconds of fame every week, your intro. And let me say, you rocked it today.
Thank you.
They're going crazy in the crowd.
The guy, everybody here in the studio so far has really brought a lot of joy and energy, and I appreciate that.
Yes, we have
it shows.
There's not a lot of oxygen in the room today, but before we get to our amazing guests, let me welcome everybody to Silicon Valley Impact. I'm your host, Brian Sparks. The purpose of this show is to have honest conversations about what it takes to build great businesses and communities so that you can make an impact in your own. I'm still reading that, Brian, but it's sounding really good. I gotta be honest.
I don't think we want to have that debate right now. Let's save that for off camera
another time. Okay, so without further ado, I want to bring in my rock star guests. I have two individuals, and today, Brian, we're like B squared and V squared today
love it.
with Vishal and Vrinda. Good to have you both in. Vishal, my buddy, good to see you.
Nice to see you again.
Yeah, good to see you. Vrinda, good to see you. Happy to have you. We've been trying to coordinate this for a while. I got a chance to meet you at Startup Grind. We hit it off, had a great conversation. You know your stuff, so I'm excited to have you here today.
Thank you so much. I'm pumped to be here.
You're pumped to be here. Okay, again, the energy is palatable in the room. But before we get into it, again, let's do a quick intro. Sure. Vishal, I'll let you kick it off. Give a little intro and let our millions and millions of fans know who you are.
I just have one complaint. How come I didn't get the same introduction that you got with all the fans?
The cheers. Oh, wait, hold on. Come on, everybody.
Yeah. Ladies and gentlemen,
let's do the
please give a warm welcome to Vishal!
Let it rip. Wow. If that doesn't get your blood pumping, I don't know.
You're up, baby.
That was it. Brian, first of all, thank you for the invitation. You and I know each other for some time now. It's always a great pleasure always to hang out with you. Quick background, you said keep it under a minute, so we'll try to keep it under a minute. Grew up in the Bay Area, some personal background. Been part of a venture as well as an entrepreneur family. So saw it really upfront in terms of what venture and innovation is all about. And I've been running a family office for the last about 20 years. And people have been asking me, what is a family office? It's a very simple thing. One family made a boatload of money, and my job is not to lose it. Mm-hmm. So, and we've been around for about 20 years. And what we do is we've invested into kind of 3 or 4 different buckets. One bucket is on the venture side. Venture capital firms. We have also made direct investments, and about 50% of our portfolio is in public markets.
Okay, and we're going to talk about this. Isn't something you just picked up a few years ago. This has been something you've been doing for decades, and your family's been in it. So there's some history, there's a track record, and so we're going to dive into that. Why you love it, because you seem to balance business and fun really well. Yeah. So we'll talk about.
It's fun first, then business.
It's fun first, for sure, and there's no shortage of that. Vrinda, again, good to see you. Tell our audience a little. Do you need the intro too?
Of course I do. Of course.
Of course you need. Brian, cue the music.
Ladies and gentlemen, please give a warm welcome to Vrinda!
Give us our theme music.
How's that?
That's the best introduction I've ever received. Way more fanfare than I deserve.
No, you deserve more. That was actually, I think, short of the mark.
We bring the heat.
Too kind. Happy to share some background. Bummer that Vishal got to go first and have a much better background than me. I'm Vrinda Agarwal. I was born in India, and I moved to the U.S. when I was just 5 years old. Moved to Sacramento, California with my immediate family, mom, dad, and brother. Dinner table conversations were always focused on technology. My dad is an electrical engineer. Mom and brother both work in tech. So as the black sheep of the family, I decided to go into finance. Worked in investment banking for a couple of years. I went to Berkeley for undergrad, go Bears. worked in investment banking at Goldman Sachs right out of undergrad, spent 2 years doing that, and the tech bug really caught up with me. So I moved over to Google Nest post Nest's acquisition by Google, but when Nest was very much still functioning as an other bet. So basically it was a way for Alphabet to not report Nest's earnings at the time. Happy to go more into that, but got to put on my product operator hat for 3 years. So did everything from global pricing strategy to some corporate development work to building the business case for new product introductions, understanding the importance of unit economics, and then eventually saw the integration between Google hardware and Nest. Did that for about 3 years, absolutely loved it. Went to business school at HBS and decided to pivot into early stage venture investing. Interned at a couple of venture funds during my time at HBS, explored different stages, sectors, just different styles of investing, and have been at Penny Jar Capital for the last year and a half now, where we have been focused on early stage B2B generalist investing. We were founded in 2021, so first fund, very entrepreneurial, feels like a startup in ourselves. It's 2 partners, Bryant and Rich and myself, and our anchor LP is Stephen Curry, the NBA player, which we're very proud of.
Wow. See, Brian, this is why I don't do bio reads. I mean, these two have such accomplishment in their history.
Yeah.
If I were to read that, our audience would be just like out the door, right? Or asleep, one of the two.
Well, and Vrinda, I think you kind of undersold yourself just a little bit after Vishal introduced himself, because you've got quite a list of accomplishments,
Amazing,
right? I mean, you've done amazing things.
Yeah. Well done. So you clearly, we're going to talk about catching the bug, because it sounds like at some point you caught the startup bug and then launched yourself into the ecosystem, bounced around a little bit, got great experience. We'll come back to that, but Vishal, and we'll talk a little bit about this background and like what brought us here today. But Vishal, with you, you're kind of the other end of the spectrum. This has kind of been a family legacy. Talk a little bit about how your family got into this, and then when did you catch the bug? Did you go, hey, no, I'm going to be, at some point when you were younger, go like, I'm going to do my own thing, and came back, or was this always the track you wanted to take?
Yeah. So I think I was born into this. My father was a successful entrepreneur and a venture guy in the Valley. So he did a few startups, he did one venture fund, they did well. And, when you see everything really up front and close, the bug is natural. Mm-hmm. But however, at the same time, I was so engrossed in it. I was thinking when I was applying for business schools, I didn't want to go to Stanford or Berkeley because everything's revolved around technology. Mm-hmm. I didn't know if I was going to be a tech entrepreneur or whatever the case is. So I went to University of Chicago. So I wanted to go work in New York as an investment banker at Goldman Sachs or something like that. But guess what? Silicon Valley brought me back. So I'm still in tech. I probably forgot 90% of what I learned in finance
Yeah.
at University of Chicago, but that's okay. Maybe I shouldn't have disclosed that. Anyways, so coming back to your question, it was just natural. And I really saw from an innovation standpoint, from a structuring standpoint, a lot of things have changed. If I can give you one story, one of the funds that we've invested into early on was a Sequoia fund in late 1990s. And interesting enough, I found this old 3-hole punch binder in a bookshelf in my dad's office. And I took it out and I was looking at it. It's like a fossil. And I was reading all these, and there was a few things that I kind of spotted. We were still using our AOL accounts. We're still using faxes. And you remember those faxes that you had those carbon copies, and by the time I fax it to you, fax it back to me, it's so perforated so you can't even see anything.
Yeah.
So we're still using that. But interesting enough, there was an ink signed letter from 2 managing partners of Sequoia to my father stating that the Silicon Valley is awash of capital. So what I did was, I went to Google. I didn't know what awash meant. I shouldn't have admitted that too. So flooded. So Silicon Valley is flooded of capital. And Sequoia in the 98 vintage closed the largest fund ever in the history of Sequoia Capital. Would you want to guess how much was that amount?
This is in the 80s?
98, 99. Yeah, just pick a number.
Okay. 500 million.
500 million. Okay, so it was between 50 and 500. So it was 339 million.
Okay.
And today's definition of awashed is Lightspeed closed 7.25, General Catalyst closed 6.5, Sequoia closed 13. So the definition of a washed have changed. Why? Very simple, is because there's so much money supply in the system coming from everywhere, not just within the United States, but all over the world. So, right, if you look at it, we have a lot of countries like China, Middle East, Japan. All of that funds are sitting in Silicon Valley.
Wow. Yeah. So there's a lot of opportunity, and you've positioned yourself through the span of your career to get a front row seat of what's coming in. And we're going to talk a little bit about venture, startup, and public markets as we kind of push along. But Vrinda, talk a little bit how you caught the bug. You said you were kind of the black sheep in the family. What was the moment where you just said, I'm doing this and I'm headed west?
Yeah. So growing up, my dad worked at Intel. Intel is what brought us to the United States, gave us a lot of opportunity. It, came to be during the rise of semiconductors. And so my dad is still there. He's about to retire pretty soon after 26 plus years at Intel, but was really there during this meteoric rise of technology and of semiconductor technology. And so our dinner table conversations really would be very granular into the technology that was powering computers and just the shift in computing. And then obviously there was another massive shift in computing when cloud computing came to fruition when I was in college during my days in banking, and you got to see lots of vertical applications of that. We had a Nest thermostat at home, and so I saw how cool this device was. And I thought it was really interesting and impactful, both from kind of a clean energy perspective, but also in just starting this smart home ecosystem for Google, where you already saw Alexa products in people's home, but you didn't really see a similar suite of smart home products, across people's homes that were powered by Google. And it was Google's first time really delving into hardware as well. And so there was a team of former investment bankers who were basically serving as internal strategists, internal consultants at Nest. And one of them reached out to me and asked if I would be interested in joining the team. And it was basically a tiger team for the CEO of Nest, where we would be handling everything kind of strategic finance product, fast-paced team, again, mentioned that Nest was operating as its own self at the time. So had its own office out in Palo Alto, had its own systems. In fact, a lot of them were legacy Apple processes and systems, given that Nest was founded by two engineers from Apple, Tony Fadell being one of them, but, had a very storied past and just felt like an interesting kind of company. It also felt in my career to that point, having gone to Berkeley, having worked in investment banking, I hadn't taken a ton of risk. And so this felt like a way to take a little bit more of that risk, but still have the backing of Google's balance sheet. So it was a kind of cautious way to take that risk. Jumped in kind of head first at the opportunity, was a little bit nervous to leave the comforts of investment banking to some extent, but knew that at some point I wanted to work in early stage technology. My now husband, then boyfriend at the time, was also an engineer working at Apple. So again, it was just constantly around me and continued to be a dinner table conversation. So I knew at some point I needed to work in technology, and Nest felt like a great introduction.
I always ask this question of our guests because I really want to know where Silicon Valley resides in people's soul. Is it just an idea? Is it just something? Are they pursuing just an opportunity? Are they just dipping their toe in Silicon Valley? Are they aware of what we're in? But what I'm hearing, and there's nothing wrong with any of that, right? But what I'm hearing from our top guests is it's in your DNA. Yeah. It comes out through life experiences, through passion. And I think if we could start to kind of pivot into the startup world, when you're looking for a great company, it's not the one with the best idea, but also with the biggest passion, because startup is hard. Now, Vishal, you talked a little bit about one of the three buckets that you're passionate about is startup. And a lot of startups at this point think, there's not a lot of money to be had. But from your perspective, what's the condition of the market for startups from a very high level? I mean, that's a big question, but just go ahead and jump in wherever you think that might be valuable for our audience.
I think it's probably the best time to start a company. Why? Even though the market supposedly is down, you have amazing talent, which is on the sideline. You have, and most importantly, you have so much money on the sideline. which haven't been invested yet. I'll give you some data on the venture side. So if you look at from what venture funds have raised, and you can confirm that in 2000, VC firms have raised 160 billion. That's the whole VC ecosystem. 2021, when the market was great, everyone was going public. You had these SPACs and you have these direct listings like Palantir and all that stuff. VCs raised almost 300 billion. So double in 1 year. Then 2022 hits, it drops down to 200 billion. Then 2023, 160 billion. And this year they'll probably raise the same amount, give or take. But what's happening is because when there's oversupply of capital, a lot of folks start different businesses, meaning startups, venture funds, things to that effect. I heard a staggering data, I think it was PitchBook or something like that. There's 30,000, you can collaborate with, there's 30,000 venture funds that are in the United States. 5,000 or 6,000 started post-COVID. So basically anyone who made a buck has a venture fund because they have access. So when I look at a fund, I know you didn't ask this question, but when I look at a fund, there's only one fundamental thing that I look at. What is the proprietary deal flow that manager has that I can't get access to?
Break that down a little bit for our audience. What does that mean? What does it look like?
That's a great question. What that means is, for instance, if I can use examples, 8VC, for instance. The founder of 8VC is a Palantir. Is a PayPal mafia member. He started Palantir with Peter Thiel. And then if you kind of look at it bouncing from one to another, after Palantir was started, a bunch of guys, early employees of Palantir, started companies like Oculus and Blend and things to that effect. And then those guys started companies like Anduril and things to that effect. So it's a trickle-down effect. So one success leads to many other successes potentially. So you've heard of course, the PayPal mafia, correct? If you kind of think about it, but many people YouTube is a PayPal mafia company. LinkedIn is a PayPal mafia company. Affirm is a PayPal mafia company. So there's so much tentacles that they've created from people who have left or were part of PayPal and started different ventures. So coming back to your question, I know I didn't answer the question, but coming back to your question is, what access do they have that I can't get access to? And that's the reason I'm willing to give my 2 and 20 away.
I love that perspective because I think on one level, that's what this show is about, having great conversations with you and Vrinda. So same question, Vrinda, kind of pivoting towards startups. Let's start first with what's your thesis in terms of the startups that you're looking for? And despite the word on the street with now being a good time or not a good time to start a company, Vishal saying there's a lot of opportunity out there. What's your take on the current conditions of starting a venture fund? Or not a venture fund, sorry, a startup.
Yeah, so a little bit more about the fund. So we were founded back in 2021, and the thesis is we are B2B generalists. We invest pre-seed through Series A. Average check size for us is $1 to $2.5 million, and we play nice with other firms. So we're pretty flexible in terms of how we come into various rounds. So we've co-led before, we have participated in rounds. And largely what we're looking for is, especially given the nature of how early we invest, we are just looking for incredible differentiated founders with grit, unique insights, an interesting background, somebody who thinks differently from the peers around them. Obviously building in big markets, of course, as all VCs will tell you. And largely speaking, we think that we like to invest in unsexy businesses. And so some of our more recent investments are not announced. I won't say the names of the companies, but one was in the construction tech space using AI. One was in the fleet management space and they're automating back office operations. One was in the dental prior authorization space. But I think right now is a very interesting time for founders because of the AI revolution. I actually think that AI has leveled the playing field significantly for founders with just the speed that it takes to build a product. You don't need to be an AI ML engineer to build these products anymore with the rise of LLM technologies. I can go out and build a basic chatbot. And, I was a economics and political science major, so I've never coded a day in my life. And you can actually also get these products out to market pretty quickly. So I think right now is just such an interesting time for people to be building, because I think the playing field has been leveled, and there's so many different industries that you could go out and try to automate. One of our partners is based in Milwaukee, and so he's largely focused on manufacturing, innovations, and digital industrial. And these are still largely untapped industries, and AI. I also, just from an investment perspective, I think the last couple of years have been slower, but this fall, I'm starting to feel a lot more energy in the markets. I've already in the last couple of weeks seen many interesting companies at the pre-seed and seed going out for rounds pretty soon. So I can feel it starting to come back alive. Yeah.
So I want to throw this out to both of you. What I'm hearing you say, and we were talking about this, Vishal, before we went on the mic, is velocity. At what startups are expected to scale at. In 2 years, they're expected to hit this mark. You contrast that with years ago, with when they're supposed to hit the same mark. It's a lot longer. So with AI accelerating so quick, how do you balance the velocity of a company versus sustainability? I mean, is that a thing where a company's growing so fast, but you have often seen in the past that a company can grow so fast that it can't keep up, and that could be the downfall? Where is kind of the intersection of hitting those early marks where they expect 200 million in the first 2 years,
something like that,
versus something like that, to kind of exaggerate the point? But where's that balance between velocity and sustainability?
So I think, Vrinda, you hit the point where, first of all, if you look at different pieces of stages of startups, you have the product development, you have to go to market, and then you have the growth. If you kind of put that framework, and there's many different small steps that go in between them. Product development, that Vrinda said, in the good old days, in the 70s and 80s, when you created a semiconductor company, it took 5 years, maybe 4 years, right, to get up a tape out and go to the market. So something today in 5 years, can you really foresee this? Because of technology, everything's collapsed. 5 years worth of capital, you'll need a lot of money. But if you have a technology that can come out in 2-3 months, you don't need a lot of money to get to the market. So that's one thing in terms of collapsing of the product development. Second thing is, because of that, go to market. So where you need a lot of effort is go to market. And I've always said Silicon Valley is no longer a tech valley. It's actually a marketing valley.
Say it louder for those in the back.
And it's a buzzword valley.
Yeah.
Right? I mean, if you look at the buzzwords, or just imagine about 10, 15 years ago, this whole kind of internet second wave, Web 2.0, 3.0, whatever the pundits have named, they came out with what was the buzzword? Oh my God, when you use, I'm forgetting the word. Anyways, so when you share your products, right? Like ride hailing, it's nothing but getting an Uber. Shared economy, that's the word I'm looking for. Shared economy. It's nothing but the crap that you don't want, you just rented it out. Right? Or in a nice way, any highly intensive, capital intensive things that you can monetize on a separate way, like your house, your car, whatever the case is. And all of a sudden it became big. Right? Uber, for instance, is worth more than, I think, all the rental car companies, and I think all the hotel companies combined.
Wow.
Right. So, anyways, coming back to your original question, I went all the way to different aspects of things, but it's just because everything is getting collapsed. And when I started my career in the 90s as an entrepreneur, somehow the magical number was in year 5, you need to hit this $100 million worth of revenue. And that's just collapsing. You've seen companies even today announce Glean. Lightspeed led the deal. I think they did about 120 million in the first.
Sorry.
Thanks, Brian.
Sorry. No, I was just like
in the first 3 years.
Yeah.
Was that a scientist?
No, that was completely inappropriate. I was so leaned in. I literally just leaned on my control board over here,
keeping us on our toes, Brian.
No, I'm definitely listening over here.
Yeah.
So the collapsing Glean.
Absolutely. Also, yeah. So these startup companies, like what Vrinda said, in 2-3 months, you create a product, low capital, you don't need to raise a lot of money, throw it out in the market, and hopefully someone will take, and then you go raise venture money. And what venture is buying today is the growth. And that's the reason they're giving the valuations also. Today when Glean was announced, they announced they raised 200 and something million at double the valuation from 6 months ago.
Wow.
So that's one. Second thing, current events also is Wiz, W-I-Z, if you remember Wiz. Google was going to supposedly acquire it for $23 billion. But 6 months before, their valuation was 10 or 12 billion. So things are, as long as you grow, your valuations are there.
So, Vrinda, pick up on that. You're talking again. We're talking about the velocity. Things are collapsing. What are you looking for in terms of, like Vishal was talking about, this momentum? You're buying growth. Add to that a little bit in terms of what's happening with today's market, with the integration of AI and how that is managed.
Yeah, I fully echo what Vishal said around just the massive growth that's happening right now, particularly in AI. And I mentioned the speed of development earlier, but I think it's a double-edged sword, because if you have faster development cycles, you have more people that are likely working on similar things, and you have fewer companies that have a true technical moat. And this is something that I struggle with vertical AI, is just trying to figure out what is the differentiation of this company that's going to last, that's going to outlast other companies in the market. And so, one of the ways that I've seen founders kind of combat this is, even if there isn't an incredible technical moat, you can be an incredible salesperson. You can really stand out on the go-to-market side, as Vishal was saying. And so, I used to be very focused on only diligencing technical founders, and kind of through my venture education, I was just biased towards technical founders, and also probably because of my background and my family. But now I'm especially impressed if a founder can go out and make really strong connections with customers, figure out what that customer's pain point is, and really sell to their first 10 customers, because that's not easy.
I love, so if we can for a minute, let's geek out on that for a second. What are some of those motions for these early stage founders to get the attention of customers and hit that ICP and scale quickly? What does that look like? What have you seen some founders do that were unique, or not only unique, but maybe even consistent in some others? What are some of those top of mind ideas to really get after those customers in a unique way?
Yeah, I think one of my favorites is actually living the problem. So as I mentioned, we invest in unsexy industries. I think that especially vertical AI can really disrupt a lot of traditionally, non-technical, more pen and paper industries. But oftentimes the kind of disconnect is those industries are either in the middle of the country, or not a lot of people that have the technical talent have worked in those spaces. And so lately, I've really been gravitating towards founders who have gone out of their way and put themselves in those situations. One of our founders, for instance, for a company that we recently invested in, doesn't have background in the space that he was initially building in, which was for dental clinics. Then he went and worked at a dental clinic for over a month and just figured out all of the problems that were happening, clerically speaking, at that clinic. And most people don't have that experience. It sounds at least like a niche experience. Mm-hmm. I've come across similar founders who, might have studied on the coasts or spent their kind of work time or career on the coasts, but then, moved to the Midwest and gone and shadowed people at factories. Because if you're going to sell to somebody who is working at a factory, it's very different than selling to your traditional kind of enterprise SaaS growth stage company. And so I think really being able to understand the pain points of the customer from within their environments is a cool tactic that I've seen.
Okay, Vishal, I've seen you shaking your head.
Yeah, actually, I was going to add on top of this. I've invested in some funds in Los Angeles. They've become a little bit more of, for instance, Joe Montana has his own venture fund. Jay-Z has his own venture fund called Merced. Mm-hmm. Right. So also what's happening, these startups, at least LA, at least what I've seen in LA, is besides hardcore tech, they're also using their celebrity status to brand and promote things, which is great. I mean, some of companies in Merced have gone from 0 to 200 million in 2 to 3 years because of that ecosystem that they already have.
Mm-hmm. And so is building an ecosystem from a investor standpoint, I know I'm shifting from startups to investors. Is that kind of a new push as well? Because Vishal, you've never shied away from a selfie. I follow you.
I love selfies.
I follow
We're gonna
you.
do one after this and a hug too, especially with Brian.
So,
the B squared.
the B squared and the V squared. And so this push for marketing, not only for a founder, but also the investor, is this a rising tide in to kind of overcome AI? Because right now the question is, what's going to be automated? What is going to be AI? And that need for a personal relationship, that connection to a face, I think is going to become a bigger value as we kind of move forward, whether you're on the funder side or the founder side. Am I off in the weeds? Or
And there's a third one, the LP side, who funds the funder side.
Yeah.
So I can talk about that, but if you want to talk about from the venture side, how that's changed.
Yeah, no, Brian, I think you're spot on, because at the end of the day, I really think that capital is a commodity, and VC firms have to differentiate themselves. Just like founders or startups have to differentiate themselves, so too do VC firms. And so at Penny Jar, one of our ethos really is we want to be helpful enough to our founders that they want to pick up the phone and call us, whether it's good news, bad news, in the middle of the night, surprising news, just anything that they might need help with or anything they want to share. Mm-hmm. And I really like that ethos because it builds such a personal connection.
Yes.
And I think that's just so incredibly important to stand out in venture, is just the relationships that you build. And I know a lot of people will push back and say, how does that scale? I'm not quite sure yet, but it's been kind of the best way to get my venture education is to build these one-on-one relationships with founders.
I like it.
This is all a relationship game,
Mm-hmm.
right? What Vrinda said is totally true. What I have to do also, I always kid around, is to come back to be invited to the next fund or to the next party, I still have to by hook or crook, trying to get into the fund. Right? I always kid around and say, I usually take the partners' kids to school and mow their lawns just to make sure that I'm in front of them.
Yeah.
I'm a big believer in many things, but one thing that I learned in life is if you're out of sight, you're out of mind. Right? No venture or no entrepreneur is going to say, I need to call Vishal to make this company happen. That it just doesn't happen that way. Mm-hmm. You have to really be aggressive, have your differentiation, even as an LP in many of these funds. And one thing that we do is we bring a lot of potential deal flow to the venture guys. We besides taking the kids out for dropping them to school and mowing their lawns, we do a lot of these kind of value added things. So we're always in front of someone important in the VC firms, in their eyes, to make sure that we come back for the next party. Next party means next fund. Yeah,
I like that. And before we go to a break in a minute, I want to say this about Vishal. I think you and I met in terms of adding value in various places. You say, you're in the face of a lot of VCs and stakeholders, but you've donated a lot of your time to, great causes. I think I spoke with you when you were at the San Jose Library giving a talk, and we spoke together, I think, at Foothill Junior College one time. So just because, Vishal talks about these high level engagement, I think what's amazing about you is you also don't forget who those individuals who need to be poured into.
Absolutely.
Right. So I value about that. So
just before we go to break, I'm just going to add to that, as an outsider looking in, it's just nice to hear that both of you are noticing or prioritizing the human quality of the relationships between founders and funders. I think that's very cool to hear, because sometimes it seems like the funders are just sort of cracking the whip and saying, make more money, or we're going to pull our funding. And to hear you guys say that it's also a human thing is cool.
Can I just add to that? That's an important point. VCs are not vulture capitalists. I think you would agree.
I agree. 100%. Yeah.
We want to build relationships, and we want to, once the money is in, we are together, right? And when I put money into a fund, I'm together with them, and they put the money to their portfolio companies. So if something really screws up, if the entrepreneur is not able to perform for whatever reason, he or she is not able to perform, then the venture guys are going to get in. And there was a certain point of time, I would say 21, 22, when it was a fad not to get a board seat by venture funds, because I just want to get my money in. It was a fad for not to do quarterly or monthly meetings. It was a fad not to take an equity round, right? Let's just get our money in. The entrepreneurs goes and does whatever heck they do, as long as we got our money in.
Yeah, I like that. Brian, I think that's a good segue to our break.
We're going to take a little break.
We'll be right back. All right, and we're back. And I'm glad I was paying attention this time, Brian, because last week I wasn't even look at you, and there was like 5 seconds of dead air, and I woke up out of a...
Yeah, we all said, okay, we're going to get back on here, and then all of a sudden you decided to look at your phone, which I appreciate you being here as well, Brian.
I temporarily zoned out. I don't know what happened, but we had a moment. But anyway, during the break, we were having a great conversation. So, Vishal, I'm going to kind of just pass the mic to you and let you lead the discussion we were just having during the break.
Yeah. Is it okay for me to take your job?
Yeah. Please take the controls.
I see an equipment malfunction going on there. I'm going to come fix that, Vrinda.
Thank you. Sorry about that.
All right, go ahead and ask. Well, while we're fixing that, go ahead and ask your question.
So I think kind of let me put the framework around this is the data that I gave you beforehand in terms of 2021, the venture community raised 300 billion, of which from there to now, I think 5,000 or 6,000, whatever the thousands of venture funds have started since 2021. So that was one of the waves. A second wave was that when I started investing into venture in the late 1990s, their investment cycles were usually longer, meaning 4, perhaps 5 years. So what happens there is, you get, and no one has a crystal ball in terms of when the market's going to go down and whatever the case is. Because if you invest into one bad year, start investing into one bad year, and you put all your capital into that year, the fund is not going to do too well. But if you invested in terms of a slate of, say, 3 to 5 years, you're hitting different market cycles. So I'd love to hear you started your fund in 2021. What was your learnings and kind of or challenges?
Yeah, and I can speak to it, although I started at the fund in 2023, but just looking back in time at how we've kind of just the pace of investment that we've had. So back in 2021, I was at a different venture fund. A lot of people at the time were deploying a lot of capital into massive rounds. I think we talked about this earlier. Diligence cycles were a lot shorter. There was word on the street that people were getting term sheets after a first meeting, term sheets going out on WhatsApp. There was just a big bubble happening at the time. And I think one of the things that we're proud of at Penny Jar, and I speak with the partners about this, is just time diversification of our investments. There was obviously massive hype in 2021. We could have invested our entire fund back then, but we made a handful of investments in 2021 when we kicked off and have made approximately the same number of investments every year. So in 22 and 23, now going into 24. And so we tried not to get swept up kind of by this cycle. And, being a smaller first fund, we're obviously to some extent price sensitive as well, which was a good, I think, forcing function. But yeah, we're proud of the diversification, especially on time.
So I think what you're saying is discipline is very important, especially on the investment side.
Yeah, incredibly.
So how can a founder be aware of this? So if we can kind of redirect it toward them and their insights, could they say, well, there's not enough money out there at this point because the investors are looking at the cycles? What insights from this perspective? I mean, this is something you two are sharing with each other, but break it down for our first-time founders who need to consider cycles and how they can engage with you during these cycles.
Yeah, I often have founders explicitly ask me, are you all still investing? So we're in the process of raising our fund 2 right now, but we're very much still actively investing out of fund 1. So I think the transparency is always helpful on both sides. But I think founders can also read the tea leaves a little bit based on just looking at, how often funds have been investing, pace of investment, kind of average size of check, if that's sort of changed over time as well. I think if you look back at some of the kind of best funds or best performing funds, you'll see that hasn't largely changed over time.
So what I tell my entrepreneur friends is look at one simple thing. Who just closed a fund? Who just closed a fund? So what that means from a structure standpoint, venture funds deploy over a certain period of time. Even though funds are 10 years, and I don't know why it's still 10 years because holding times are 20 years now, right? If you look at Reddit and things like that, Reddit went IPO after 19 years. But let me get off that tangent. So from the fund side, it's a 3-year to 5-year investment cycle. So that means say if it's a $300 million fund, whatever the number you want to use. So they're investing typically $100 million the first year, $100 million the second year, $100 million the third year. Rough, give or take. So for entrepreneurs who want to focus on, depending on what industries they're focusing on, first they should look at which funds are actually putting money into that industry, number one. Number two, who has closed a recent fund in the last few months, few weeks, few years, whatever it is. Maybe a year is 2 months. A few years, it might be too long. And go target them because they have dry powder. We don't want to have a fund that's already is in the fundraising process because they're just going to push it out.
How let me again ask a basic question in the eyes of a first-time founder who needs access. So they're going to need insight that you're sharing, right? And they're going to need FaceTime and access to these potential funders. What are some strategies for these founders to get that FaceTime, to stand out? Because you're going to get hundreds of unsolicited emails and pitches when you go out. But what really gets someone to stand out in your book?
Yeah, as an investor, I'm at events all the time. You know, Brian, you and I met at an event, and I think having that in-person, meeting, just that FaceTime can be really special because I think within kind of a minute of hearing that in-person pitch, if you want to have a second conversation with that person versus, getting dozens of cold emails or LinkedIn messages every week. So I think, going out and finding investors where they're at, which is in-person events, oftentimes they're hosted by investors. Living in San Francisco, I think there's just such a vibrant community, especially around AI now. So things like hackathons. And I think if you can, get a warm introduction because the investor will just be more inclined to want to respond to you, especially if it's coming from somebody that they trust. So, I'm way more likely to respond when I have an investor friend or a founder friend introducing me to another founder versus if it's just cold.
Okay, Vishal.
So there's a few things I said I live by. Another one I live by is you're not going to get ahead. You're not going to get ahead sitting at home. So what Vrinda just said, you got to be out there and look at which investors. Going back to the first thing which I mentioned, which fund is closed recently, what sectors they're investing into, target them, target where they're going to be, go meet them. This is going back to what we said before. This is a relationship game. But one thing I felt that even warm introductions typically don't go too far. So, but that's debatable, I guess.
I think it depends. It definitely gets your foot in the door for a first conversation. I will always take a first conversation if it's a warm introduction, and usually it's someone who knows our investment thesis. So if they're introducing me to a life sciences company, it's way outside of our scope. We're probably not going to look into it, but if it's a founder friend, especially, I always find that the best references come from great founders know great founders. And so if it's coming from, especially within our portfolio, I will definitely take a first call.
Also, just adding to what Vrinda said, also if there's relationships as an entrepreneur that you've made with a bunch of portfolio companies of a venture fund, and if they're strategically investing into the kind of the supply chain of the whole industry, and you fit in there somewhere and you build a relationship with their companies, that's a great way. Yeah. Even more than from an LP, because now you're making money. These guys have seen where you can fit in to make money for this fund, for this company.
Yeah, there is a PayPal-esque mafia type lineage to those connections. All right, to kind of pivot off of relationship development now, but before we started the show, Vishal, was asking you, hey, what's top of mind? What do you love talking about? We've kind of covered some of those things. I want to dip our toe a little bit into the state of the public markets right at this point. Where do we begin with this? What do we need to be aware of for our audience, kind of at a high level? What are some of the top 1, 2, or 3 indicators of where we're going and where we're at?
Yeah. So this week is pretty big, meaning from multiple public market sites. I was kidding around with Brian. First was the NFL openers, and the Niners finally won, so that was good. Oh, not finally, but they won their opener. But more importantly, yesterday, Oracle announced great earnings. And there's actually a rotation that's happening in the market where it's actually going from AI infrastructure companies to perhaps AI application companies and infrastructure. Another big thing which is going to happen on Thursday is Adobe is announcing earnings. So we'll see how that happens. Workday did announce last week. The stock went up from 20 to 250. ServiceNow, amazing kick-ass earnings. Their stock went up from I think 650 to about 850. So there's a rotation that's happening where these companies are having amazing earning cycles, and so that's the reason the stock is going in. That's the reason you see Nvidia, AMD, Broadcom, their stocks are in not doing so well. Another thing which is happening is tomorrow the CPI is going to come out. How our consumers are purchasing and buying. So last CPI was a good indicator that the industry is, or the market is healthy. So tomorrow is going to be another big day.
So for our audiences, really quick, on a bookmark that really quick. We're 1 week behind in recording, so this has already come out. So those of you who are waiting for something tomorrow to happen in real time, it's already actually happened.
Okay.
So just FYI.
Also, can I go back to the Niners winning last night?
Yes, sir.
Are you making a correlation between the Niners having a good year, let's say a Super Bowl trajectory, to the economy being better off here in Silicon Valley?
That's what I heard.
That's what I heard.
Absolutely. And there's another thing. I just turned 49, so hopefully.
It's your Niners here.
Well, and we, to some degree, have Steph Curry in the house here.
Absolutely,
so,
absolutely.
All right. Okay, so there's a lot of good news coming out. And so,
Well, there's a lot of news coming out. So good news was Oracle yesterday. Tomorrow or Wednesday we'll see what happens with the CPI, and then Adobe on Thursday.
And so how should we position ourselves from an audience perspective, whether they're just the observer, they're a casual investor, angel, founder? What are some of these indicators going to lead them to start thinking strategically in the next quarter, half year?
First of all, since everyone's disclosing, I'm not a financial advisor.
Yeah, I mean, okay, so this is for educational purposes.
No,
This is only for educational purposes. Yeah, so why are you geeking out to this?
Why I'm geeking out is I think it's going to be an amazing time to buy in the next 1 month, because forget the companies that just announced. Historically, this segment of the year, markets dip 10, 15%. So I'm not saying go cash, but that's what I'm doing. And then the market roars after that. And I think, depending after the election, and I know we won't talk about the election, but after the election, no matter who becomes the president of the United States, the uncertainty is gone, and it's just gonna be an amazing time till Christmas. And I believe, I was actually sitting with the Goldman Sachs chief economist. We were talking that we believe that 2025, well, I shouldn't put words in his mouth, 20 to 25 tech IPOs will happen before Christmas.
Oh,
So
wow.
Santa's going to come with a lot of gifts.
I love it. Yeah, Brian, I got to say that sometimes I'm sitting here and I forget, I mean, even with all this equipment around us, I forget that there are others listening. And again, I want to reemphasize for our audience, this is for educational purposes only. None of us are here.
This is not investment advice.
This is not investment advice. This is just some friends sitting around chit-chatting about.
I deserve to be here, and I'm worthy of being here. And whatever I don't know, I can learn.
Yeah, thank you,
That's
Mercedes. Yeah, that is it.
That's all.
That is all.
Also, just to kind of summarize, there's these companies which are out there, these private companies that are doing, like Stripe, $8 billion in revenue. I mean, I shouldn't name names, but a lot of companies that are in the 500 million run rate, and some are profitable, some are not, but they're ready to go out, and they're very hungry to go out. Why? Because it's been the last 3 years has been very dry for investors. Returns have not happened, and whatever the money came back in from at least the venture side, they recycled it. Recycle means just return, and they reinvested it, which they have the right to do. And so people like me, we need returns so we can start reinvesting that capital in the innovation ecosystem here.
Let me kind of back down a little bit, talk a little bit more. I mean, oftentimes those who are just observers of the startup ecosystem, they hear the word VC, they hear the word founder. Talk a little bit about what a family office manager does.
So it's actually, I joke around, I'm more like an admin. It's a sophisticated. So what we do is, on the private side, I keep on trying to be in front of, one of my things, out of sight is out of mind, be in front of many of these GPs or general partners who are actually investing the capital, and try to make sure that they know I'm around, that the next fund when they start, they'll invite me to the party. So that's one thing. Second thing I'm doing is because of that, I have some opportunities to co-invest with them on some of their so-called winners. So I've invested so far in about 30 direct investments that haven't died yet. So and my focus is more on later stage companies. Maybe it's because my age of 49, I don't know, but also the holding period of these startups have gone from a handful of years to multi-hand years, meaning from 4 or 5 years of exits to maybe 10, 15 years worth of exits. Perfect example is Reddit, right? Reddit went out after 19 years, and I think they almost died 3 times. So for an early stage investor, that's very hard. So what I've done is, and what we're looking at from a strategy perspective is invest into venture funds, and hopefully they'll invite us to some of their companies that they're putting money into. So that's happened 30 times. So
30 times.
Yeah.
Okay. You got the experience. Vrinda, let me kind of go another direction with you. We're kind of winding down the show. I mean, the hour goes quickly.
Oh, wow.
What's next for you in Penny Jar? You're in the process of raising another fund. What's kind of your strategy to raising at this point without, again, asking for any raise at this point? But how do you approach this? You have a smaller team. You have huge deal flow. You've got to manage a lot. So how do you kind of attack this stage of your company and the market?
Yeah, going from a fund 1 to a fund 2 is very hard. The stats will show that oftentimes fund 1s don't make it. We are really lucky to have a very dedicated, existing LP base who have also been very helpful to our companies over time. So like what Vishal was saying, some of our LPs have come and invested in our companies. Others have helped solve problems, made customer introductions, etc. So our strategy, at least approaching the first close, has really been to focus on that existing LP base. And we've, obviously built close relationships with them in the last several years and want to continue doing so in Fund 2. We're still kind of at that point where we're probably too small to be an investment from an endowment or a pension fund. But I've, started to build some relationships across my past alma maters, Berkeley, Harvard, et cetera. And that could potentially be an angle for us to raise, maybe if not in this fund, then starting to build those relationships for future funds as well. So I think that and just a little bit of patience.
But I think a lot of these large institutions now do have programs for emerging managers, correct?
Yeah.
So I see when I go to all these AGMs, there's Cornell endowments or Duke endowments, and they're aggressively looking at emerging managers.
Yeah.
At the same time, when you said it's hard for a first-time fund, but if you hit the right fund, that's the best fund, as you know, in the whole vintage of the history of the fund.
Yeah, exactly.
So.
Yeah, I mean, we're always excited to bring in new LPs as well, especially if they're endowments or associated with college campuses. Any of our alma maters are incredible. I found oftentimes, though, when they're looking at emerging managers, they're looking at spin outs of existing larger funds. But correct me if that's wrong. We're always
that
looking.
is true, but that's also a double-edged sword because some of the managers who leave they leave for a reason.
Yeah, that's also
right?
very fair.
And it's on the other side also. I've always called, well, I'm going to say it anyways. I always called venture funds. They're not really, they're partnerships. In many cases, there might be dictatorships.
Yeah.
Where 1 or 2 people control, and the people who are working surrounding the junior partners are working hard.
Yeah.
And getting the best deals, but they're not getting the right carry percentage.
Yeah, I think culture is everything. My HBS classmates and I who were going into venture thought a lot about this, and I think almost all of us indexed for the culture of a fund.
Yeah, and also generational. Like if you look at some funds have done it amazing in terms of transition to the next level.
Mm-hmm. Yep.
These older funds, right? You see NEA has done well. Sequoia did amazingly in terms of next, and some have not done so well.
Yeah.
So I got 2 questions. You can take them in any order. You said culture, number 1, and going from fund 1 to fund 2 is often difficult. For the first part, I have often shared that all money is not good money. And if there's bad culture, then a good founder may want to think twice about possibly partnering. How have you developed the culture within Penny Jar? And what are some things that a founder can look for? And we only got like 90 seconds left. Should look for when taking good money. What does that look like?
Yeah, I credit Bryant and Rich, the partners at Penny Jar, for building an awesome culture that is highly entrepreneurial, very open and transparent, roll up the sleeves and help. We all do the same job. There's no job that's kind of too small for them to do, that they're sort of passing on below them or anything like that. So, largely everyone is kind of on a level playing field, which is just a great culture to present to founders as well. But I oftentimes tell founders that during a VC's diligence process, it's just as much a diligence process for them to diligence the VC. So ask to speak with founders, who the firm has invested in. Try to meet with founders who the firm hasn't invested in, who have gone through the diligence process. It's a little bit harder to find, but you can probably find them through back channeling and ask the tough questions of what are these folks like to partner with.
That's great insight. And I know I didn't give you time to get to the second question, but how can people connect with you? LinkedIn, what's the best way to connect with you?
Yeah, LinkedIn is awesome. Email is great. Happy to share that as well.
Okay, I'll put that in the show notes possibly. Vishal, thank you for being here. Last minute points of wisdom, and how can people connect with you?
Oh, just email vishal@edgewoodvp.com.
Great. Well, I want to thank you both for being here. Brian, how we doing, buddy?
Yeah, you got a little bit more time if you want it, Brian. I don't know. It sounds like we're wrapping up, so we can do that too. If you're good, we're
well,
good.
I don't want to end on that note, Brian.
I'm just, I'm not giving you the cut signal. And you're
Usually
telling
you're
me
over
to
there
cut the thing,
frantically
so.
waving your arms. Shut up, Brian.
Let's go back to Vishal for just 1 second. How do you think the Niners are going to stack up against everybody else this year? There's a lot of really, really, really good teams this year.
It's a tough season. At home, we got Taylor Swift coming in on October 20th. We Swifty Wave, yeah.
All right, that's good enough. Vrinda, how do you think the Dubs are going to do this year?
I think the Dubs are going to crush it. I think it's going to be a great season. I also think my hometown team, the Kings, are going to do great
my next
with the
question.
addition of DeMar DeRozan. So we're really excited about that.
I think that was a great pickup for the Kings.
And join us in our next hour when we talk sports with V squared and B squared.
All right, I think. What's that? Yeah. I hear the.
I love it. All right, all together now, and that's a wrap. Thank you for listening to Silicon Valley Impact. You can join us here every Tuesday from 3 p.m. to 4 p.m. Make sure to connect with me on LinkedIn. I'll see you all next week. Take care. See you soon.
No.